I'm Ella Doherty, and I expect that the reason you're looking at this video is because you're considering financing or refinancing your business. My job as your advisor is to help you decide and let you know the different options available to you. You have choices, and once you've thought about them, the direction you go in might be different to what you first thought of or imagined. Whatever you choose to do though, preparation is always the key. So before we start, let me ask you 3 simple questions. First, why do you need credit? What sort of finance do you think you need? And lastly, where do you think you can source the finance from? I'm not going to tell you what to do or what choices to make, but it's always easier to make the right decisions when you have the right information in front of you. It's also important to know what you need to hand when you're asking for a loan. Hopefully at the end of my presentation, you'll have enough information in front of you to make the right decisions for you and your business, because every business is different, and what might be right for one business is completely wrong for another. For instance, I had a client who had been advised to take out invoice financing in order to pay a large debt. The finance would have been relatively easy to obtain, but it would have endangered the cash flow and therefore the business. So let's think about this first. Why do you need the loan? This might be as straightforward as, I need a new truck, or because I can't pay the rent right now. But let's look at this a bit more deeply, because as I have said, getting the wrong finance for the wrong reason can be a death sentence to a company. Do you need a loan at all? This might seem a silly question, but sometimes we think we need extra cash right now, when in fact what we need to do is plan our spending and manage cash flow. Another thing to think about is, are you growing too quickly? Fast-growing businesses look good on paper to begin with, but when you take into consideration profit margins and overheads, you might find that the cash flow issue is just that, an issue which needs dealing with before extra cash is obtained for whatever reason. Sometimes, rather than feed the growth, we need to change or even slow down the way the business is growing in order to keep it sustainable. Sometimes we have to say no to the large sales in order to make sure the regular sales are sustainable. Not long ago, I had a client come to me to assess the business. The owner had become ill all of a sudden, and the company had been running without direction for a few months. By this, I mean that the department heads knew what they were doing, they knew what they had to do for their department, but there was no one giving the company direction, and so they were all trying to direct the company. They were asking each other questions, communication broke down, and after a short while, a bit of panic set in. Now, before I walked into the office, there was a panic that the business had little cash flow and it wouldn't be long before the suppliers would come knocking at the door. It did not take me long to see what was going on, however, and how the land lay regarding finances. It became apparent that all that was needed was some coordinated credit control and payment plans, as the taxes had all been paid, and in fact the business was going reasonably well. It just needed a direction, not more investment. And I can tell you that not only did it survive that hiccup, but they also survived the recent lockdown by cutting back and using the furlough leave available to them. So scaling down and keeping going. So you've decided you need finance to help drive your business, so let's look at your options. There are quite a few different types of finance, as you may be aware, which fall into 5 main categories: overdrafts, short-term loans, invoice factoring, asset financing, and long-term loans or mortgages. Let's look at these in a little more detail. Overdrafts. You would use this for business or personal cash flow purposes. It can be set at various levels and is often the cheapest, as it would only cost you in interest when you use it. It should be the easiest type of financing to obtain, but often isn't, because the banks want to lend you money when you can afford it, but aren't so keen when times are hard. I have had clients change banks simply because their original bank was not prepared to offer a sensible overdraft. Also, please note, the banks will often ask for a guarantee. More on these later. Short-term loans. These are loans repaid over a fixed period, usually less than 5 years. As with overdrafts, these should be fairly straightforward, but it's a good idea to shop around if you can, because there are lots of alternative sources of loans other than your own bank. Often, however, your bank would give you the best interest rate if you are an established customer. Invoice factoring. This was the new thing back in the 90s and early noughties, as you agree that the factoring company loans you a percentage of your sales invoice once raised, and you pay them back when the customer pays you. There are two main types of invoice financing, or factoring if you prefer. One is open factoring, which is where the customer is made aware that the invoice is factored, and the financing company chases the customer for the debt and pay you the remaining balance once they receive the money from the customer. The second option is invoice financing, or closed factoring. This is where the customer solely deals with you and you chase the debt. So far as the customer is aware, no one else is involved. Depending on your type of business, you might prefer this low-key approach. These days, there are lots of small variations on the above themes, but basically they all loan you money against your sales, so you always know that you can repay the debt. Please note, these companies will charge you for their services, and it does not always work out as cheap finance. Asset financing. This is good for companies who are asset rich and cash poor. In other words, you've lots of plant and other assets, but not a lot of cash, and you need more plant. Again, a few years ago, a lot of companies freed up a lot of cash by selling plant and motors and then leasing or repurchasing the same plant or new under finance. For example, I recently spoke to a large financing house about buying various assets, from trucks and plant or even a plane, and they'd happily fund up to 70% of the purchase price over 5 years. One of the reasons why this is so popular is because the cost of the asset is then matched, or nearly matched, to the period of the asset's useful life. This is good when looking at employee cars or heavy machinery, which is usually swapped out for new replacement every 4 or 5 years anyway. The risk here is to have equipment which has depreciated in value quicker than expected and is still under finance, which has to be repaid. All of the above are reasonably short-term loans, usually agreed and completed under 5 years. The last type of loan is usually for a higher value investment and purchases, and this is the long-term loan, often a mortgage of some description. But in businesses, it can mean any loan which is repaid over a longer period than 5 years. Usually required for businesses with a large, long-term project or development, or to buy the building or factory being used for the business. Often these loans can take a lot longer to plan for and obtain than even the most experienced business owner would expect, especially these days. Please note that with all the above loans, the banks or finance companies can ask for a personal guarantee or a charge over your business. You need to decide if you want to do this, as it will affect your chances of obtaining other credit. It's worth mentioning in these post-pandemic days that there are also still government-backed loans available, such as the CBIL, COVID Business Interruption Loan, or the Bounce Back Loan. Specific for companies affected by the pandemic, you'd probably already have looked into these loans as you're in need of credit, and you may have discounted them as hard to get. So, 3 things to remember here. They are for companies affected by the pandemic adversely, so you will need to prove that this was the case, or is still the case, that your business would have been doing fine, thank you very much, if it wasn't for COVID. That if you can get the loan, your business will still be operating well, and most importantly, you'll be able to repay the loan a year down the line when the repayments kick in. So, you need to get a loan. So you've thought about your finance you need, you've considered your options, and you've decided who you're going to approach. but what do they want from you? I'm often asked this question, and usually after the client has spent hours on budget forecasts, cash flow forecasts, bank reconciliations, and gathered every piece of paper available to them, only to find out that the bank wants them to fill in a form. It's a good idea to get your accounts as up to date as they can be, so when asked how much are you owed and what do you owe, you have the evidence in front of you. So, before you start, make sure you have the last filed set of accounts. This is quite important, they will want to see these. Post all of your sales and purchases onto your whatever bookkeeping system you have. Post and reconcile your bank account, and you can ask your accountant for help if you need to. You also need to prepare a basic and realistic cash flow forecast for the next 12 months. Don't be too optimistic with this. Base it on past performance if you can, allowing for the recent COVID effects on your business and anything else that may have affected you. Post and reconcile your bank account and ask your accountant for help if you need it. Prepare a basic and realistic cash flow forecast for the next 12 months. And don't be too optimistic with this. Base it on past performance if you can and make allowances for COVID and whatever else may have affected your business. Then look at this yourself to see what repayments you will be able to comfortably afford. If you're looking at asset finance or invoice financing, this should be fairly straightforward as the sales and assets are generating the loans. But when looking at other types of loans, you need to prove you can afford to repay them. And again, your accountant should be able to help you. Then there's plan B. It's always a good idea to set up a list of what else you can do just in case you don't get the loan or finance you're after. Option B if you like. This is quite important as a lot of finance lenders will want to know this as part of their affordability tests. Basically, will you survive if you don't get the loan? This is a good question. Is this a possibility? An even better question is this the worst case scenario for you? This might surprise you, but often a company runs into financial trouble because the owner has lost interest in it, in which case it's not a loan you need, but a valuation and a good exit strategy. This might seem quite flippant, but it's actually quite serious. I know people who have walked away from a business which was turning the corner because it wasn't what they wanted. There were others in the company who were more committed and invested in it, so they sold their shares and walked away. They told me it was like the weight of the world was lifted from their shoulders, and they now had countless opportunities in front of them, whereas previously they only had one path open to them. In contrast, I had a client who believed in their business even when divorce and debt collection officers were at their door. They fought on, and now the business is doing well and survived the recent pandemic. So hopefully, I've helped you focus on what you need the finance for. And if indeed you really do need the finance, you will have a good idea of what type of finance is best for you and what you are prepared to sign for and what you aren't. Lastly, you will have a good idea of how to repay the loan. And more importantly, just going through this process will help focus you on what you want for your business and for yourself and how you want it to look in a year or so's time, when you have the loan, when COVID is behind us, and with a renewed sense of direction and energy. I hope this presentation has been helpful. Thank you for your attention, and please don't hesitate to contact me with any questions. Thank you.